presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for November the 17th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, let me remind all of you to click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Also, you can go to compact.com, click on Insights, and you'll have this YouTube update and all the YouTube updates there. Also, you'll get the podcast where Javed and I talk about the markets in a little bit more detailed perspective so you can know what we're thinking, what we're doing, and why we're doing it. Looking at the numbers last week, market was just about flat. We were down quite a bit, came back up quite a bit. People are buying the dips, but I think we've got a little bit more chop to go before we come to an end of this pullback or whatever you want to call it. I think the market is nervous. They are not sure if we are going to get another interest rate cut in December at the upcoming meeting next month of the Fed Open Market Committee. That is the Federal Reserve that sets interest rates. So we're not quite sure if we're going to get it. The market was at a very high probability earlier on, but now it's backed off from that probability. So we'll have to wait and see. And that is what is also causing some anxiety in the market. S&P was up 0.12%. Dow was up 0.41%. We saw the Nasdaq lower. Small caps were quite a bit lower. They were down 1.79% as people are expecting the economy to slow, and the small caps, small businesses are the ones that are hurt the most. Defensive sectors did the best last week. Healthcare was up 3.9%, it's a defensive sector. We also saw energy up 2.8%, and consumer discretionary, that's again, consumer spending was down, was the worst sector last week. We saw technology sort of in the middle, slightly higher, not much. Oil continues to drift lower, $58.74 last Friday's close. So I think, again, we're seeing a lot of cross currents. Inflation is still sort of hanging in there, but I think we're starting to back off from some of the tariffs as they are starting to push up prices on consumers. And that is something that the administration does not want to see. So we're seeing some pullbacks, especially on the consumer side of tariffs, and that also will be helpful in the long term. Looking at the interest rates, they were just about flat. The 10-year went from 4.11 to 4.14. Not a lot of movement there, still waiting and watching, just stuck around the 4% rate. We are expecting a slowdown in the fourth quarter GDP numbers. It was expected that the economy grew about 1%, but based on the shutdown, now we could see about a negative 0.5% number. That's what is expected for the Q4. But then that all comes back in the Q1 of next year, and then we're supposed to get somewhere around 3.5% GDP growth in the first quarter of next year. So what was here gets added on to here, and we get this number right here. We'll have to wait and see how these numbers come out. But there is some expected numbers that are going to be skewed because of the shutdown in the government that we saw. We saw small business index decline to 98.2. We've got a lot of data coming out, especially we've got the unemployment rate coming out for September. That's going to come out and it's expected to be around 4.3%. So we'll have to wait and see how that number comes out and how that impacts the market. S&P starting to fall off. This is the 20-day exponential moving average right here. And you can see that this is the 50-day simple moving average, the blue line right here. You can see today we're below at 67.07 is that number. And last time I saw the market was at 66.54. So there's some support right around here, which is around 65 and change, just below 6,600. So we could go down a little bit more, but this looks like, again, last week when we saw this market pop back up a little, I said we are going to see some more chop back and forth, back and forth. That is what we see usually in wave 4. This is wave 3 right here. wave 4 down, and then we get wave 5 to the upside. That is still expected, but we could see a little bit more chop right here. But I think somewhere around 6,600, just below 66, 60, between 65.50 and 6,600 is where we should see about another 100 points lower than where we are this morning. So a little bit more chopping around here before we start heading back up. That's the way I'm looking at it. Again, 65.32 is the 20-week moving average, and then 61.26 is the 50-week moving average. That also happens to be, again, very close to the 200-day, 6,100. I don't know if we go that far down. I think somewhere right around between 6,600 and 6,500 is where we should see a short-term bottom here. And then again, we're looking at the Santa Claus rally. That's how a market is going to thin out for the holidays. And a lot of people are sort of locking in their profits for a wonderful year that it has been this year. Same picture in the Nasdaq, below the 50-day moving average. Support right around here, just about 22 and a half, or about 22,400, about 2,200, 22,100. We're about 22,600 today. So somewhere around 22,200, 300, somewhere around there. Another 200-300 points lower for the Nasdaq is where the support comes in. So a little bit more chop again in this market before we start heading back up. That's the way I'm looking at the market right now. Against 22,000 is the 20-week moving average. Then 20,000 plus or minus is the 50-week moving average. Interest rates just going sideways right around the 50-day moving average. 4.133 is where we are today, just above the 50-day moving average. But again, as you can see, we're sort of stuck here right along this line right here, which is 4.5%, and somewhere right around here, which is right around 3.9. So just in this big range. So interest rates haven't gone up or down, but if we do see another cut, we could see coming back down to around the 4% area. Gold is correcting again below the 20-day moving average, headed towards the 50-day moving average for the GLD. That is the ETF for gold. We are at 369 today. 363 is the 50-day. I think we could test around there, but I think somewhere right around here. We might have already made the fourth wave bottom, and this is third wave, fourth wave down, fifth wave to the upside is what I'm expecting. High yield has come down quite a bit. 79 is the 200-day. We're at 80.06, and that is getting a little bit of a concern. We did come down, came back up, and now we're getting close to the 200-day on the HYG. That is the high yield bond chart, and that's something we watch very carefully, because that is the bonds on the lower rated companies, and those are the ones that are most affected if the economy slows down. Those are my thoughts. Those are my views. Again, if you'd like to subscribe to this channel, click on the subscribe button. Also go to compact.com, click on Insights, and you'll get all the updates there. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.